Howdy y'all. It is me with my home whiteboard, and just in case I have to miss class tomorrow, I wanted to give you some exciting lecture to try to get everything caught up through Friday. I do not believe I'll be sitting here for 2.5 hours, which is the normal class time we have, but I will indeed try to do my best to give you the most important concepts. First thing, I want to review, let me look at my monitor here. Okay, first thing I want to review real quickly what we did today. Let's see here. Okay, can you see that? Yeah. Davidson's capital market graph. Quantity of physical capital, price, all right? Now, let's see here. First thing, the easiest thing to do first is to, maybe I shouldn't be doing it here where there's a crack in the screen. Sorry, is that, yeah, that's okay. K1, S sub K, that's the current stock of capital. So like the current number of restaurants, the current number of factories or whatever. So it's a vertical line because that's just how many there are right now at this second. That's the current stock of capital. Then the demand curve, the demand for capital, let's see, I, whatever that Greek letter is, and E, minus, minus, plus, plus. Okay, those are the determinants of the demand for capital. I mean, the price of capital, or the price of getting a restaurant, for example. This is the rate of discount of future income, so the higher that is, the more you're like, I'm not going to wait around, I'm going to spend the money today. Oh, I better not say J.G. Wentworth, that's like a, well, they'd have to pay me, actually, now that I think about it. Just like on J.G. Wentworth, I want my money now. So when you feel like that, I is very high, if you will, and so the demand for capital is lower, because you're not willing to sit there and wait as you wait for the years of income coming from your restaurant. This is the profit you expect to receive from whatever the capital is going to build. So for example, if it's a restaurant, from the foods you're going to sell in the future. And this is the ease with which entrepreneurs can get access to finance. All right, so now the demand curve. Well, this one's the only one that's going to be reflected in terms of the slope, because we have that on the vertical axis. All the others would represent shifts. If we change one of these, we'd have to shift the whole demand curve. But let's put the demand curve on there. So now what we have is sort of entrepreneurs' valuation of how worthwhile it is to get a unit of capital right now. It's their demand for capital. Here's the current supply. If I could buy an existing restaurant, I'd pay that for it, all right? So that is the demand price of capital, all right? That's what the demanders would be willing to pay for a unit of capital. Well, turns out, however, let me change colors here. Turns out, however, you are not limited to just purchasing the restaurants that are already in existence. Turns out you can build some new ones. So now we need a supply curve for representation of the construction of new restaurants or new physical capital. First of all, P sub M, that's a minimum price. No one's going to build you a restaurant for less than this, all right? So it's not going to come out of the bottom down here, because there is no physical capital. The assumption here is that you can buy for, $1 or whatever. So this is the easiest way to think of it. It's the minimum price at which you could get a contractor to agree to build a restaurant for you. Then we pull the demand curve, the supply curve off of right here, because we're already starting here, all right? We're already starting this far out. So we already have this many. So this is the question here is of adding to that current stock of capital. So this is S sub K, which we already had, because it is that. It's that far to the right. It's this far to the right, plus lowercase s sub k. Can you see that? I don't have my glasses on anyway. In the book, in Davidson's book, this is simply a lowercase s, but it's kind of hard to see lowercase or uppercase on here, so I like to use a little script s. But the lowercase is just this blue part, just this blue curve here. That's new construction, all right? And then the uppercase, of course, is why it's that far out to the right in the first place. Okay, so it looks like we've got a good idea of what the supply of restaurants looks like, or supply of capital. There's one important thing missing, and it's going to be really important to understand that there's a difference between building a new restaurant and upgrading or repairing the old one, of just fixing up depreciation, all right? So we have to include the demand for capital just arising from depreciation, just arising from, oh, the easiest way to think about it, but it doesn't just mean this, but the easiest way to think about it is, oh, our fry cooker is really, broken down. We need to buy a new one and put it in there. So have you expanded your ability to fry stuff? No, it's exactly the same as it always was. But so you did contact a company and buy investment goods, or capital goods rather. So this is nevertheless demand for capital, but it's demand for capital just replacing old stuff that's worn out. And actually that's something that Keynes makes a big deal out of it. It's not just worn out, because we don't really care about the actual productivity. I'm not going to go into it, but it has more to do with, is this capital worthwhile? Is it useful more than has it worn out? But maybe I'll talk about that in class, maybe I won't. It turns out not to be entirely necessary to understand the graph. All right, let's say that the total demand for capital is the original demand curve, so we're that far out to start with, plus this lowercase d sub k. That's demand for capital just to replace stuff that you already had built. You're replacing what you already had built. It's wearing out, it's not up to code or whatever. It's not making enough money for you. You're not putting in, you're not expanding your ability, you're just trying to stay in the same place, all right? Now we have, finally, the total demand for and the total supply of physical capital. Perhaps I shall use a green marker. No, purple. The total supply of, which is here, and the total demand for capital, right in here. So, this must be the equilibrium price. Davidson labels that P sub F for the flow price. But the way to think of it is the supply price of capital. This is the price that you would have to pay to get somebody to supply it. This was the demand price of capital. This is the price that demanders were willing to pay. The price that people are willing to pay is above the price that they have to pay. Therefore, they're going to buy capital. All right, and they're not just going to buy capital. They're going to add to their total productive capacity. Let's see what color. I wish I had a red one. All right, first thing, I'm going to drop down from here and call that K sub 3. That is total investment. All right, gross investment, total investment. That is the number, move my shoulder out of the way. If we were using the ZD diagram, ZD, that's that number, all right? That's the vertical intercept. So whatever number is there, that's the equivalent of that vertical intercept right there. It's total investment. But not all of that investment was for building brand new restaurants. Some of it was for upkeep on old restaurants, all right? So we need to differentiate that now. Well, remember, the gap between the black and blue demand curves is the lowercase d. It's the demand for capital because we're just doing upkeep. So we know that this gap right here is just, and I'll put REPL for replacement. That's just replacement capital. And this is net capital formation. This is the net addition to the total number of restaurants or whatever we're talking about, all right? So here's the total investment, but of that total investment, this much was just for entrepreneurs to try to stay in the same place in terms of what they thought was a profitable amount of capital to have. And this was, oh no, we're going to add a new franchise, we're going to add a new restaurant, we're going to add a dance floor to our restaurant, whatever, right? That's it. Now, here's the important thing about Davidson's graph. On the surface of it, it's just a general equilibrium thing where everything comes to rest and stops. But of course, from the post-Keynesian perspective, that's not the way the macroeconomy works. The macroeconomy is dynamic. And indeed, there's a dynamic element here. Because in glancing at this, let me give you a comparison. I don't know how well you can see it, but it's just a supply and demand diagram, all right? So I just got P sub 0, Q sub 0, yeah, you can see it. P sub 0, Q sub 0 at the intersection of supply and demand. And now, so where's the price right now? Well, it's at P sub 0. Where's it going to be tomorrow? I don't know. I mean, unless something happens, it's still going to be at P sub 0. What's the quantity right now? It's Q sub 0. What will it be tomorrow? I mean, Q sub 0, I guess. Aha, not the case here. What is the Demand price for capital today, P sub S. But it's not going to be there tomorrow, and I can already show you where it's going to be tomorrow. What is the supply price? P sub F. What is investment? This gap down here. We already know, okay, everything else being equal, we already know that tomorrow, or next month, or whatever the time period is here, this whole supply curve apparatus, the black and the blue line, everything that has an S on it, is going to move to the right, okay? It's going to move to the right, and why do we know this? Because there's net investment. We know that this is going to be the net addition to the stock of capital. That whole apparatus. It's really hard to do this next part. Let's see, make it exactly the same. Let's see here. Yeah, it comes across right there. Hey, I don't know if that's parallel or not. That's why I like to do this. One time when PowerPoint's really handy, because I can block copy and just shift it in I don't know, I usually use MS Paint, and then show it on the PowerPoint. Here you're going to kind of have to guess. But I don't know if you're going to be able to see this or not. Let's see. The new P sub S is right here. There's the new P sub S, the intersection of DK and SK. And here is the new P sub F, the intersection of the total supply of capital and the total demand for capital. Look how close together they are, all right? They're getting closer and closer together, which means that the incentive to undertake investment other than just for replacement is going down, down, down. Well, that really sucks, because we need the demand curve as high as possible in order to generate more employment over here. So that's kind of what we talked about today, all right? I showed you this situation, and then I showed you the situation where P sub F was higher than P sub S, and in that case, you don't even bother to replace all the existing restaurants. You let some of them sit empty because you think that the value of these restaurants is below even what it would cost to build a new one. Just let the old ones wear out, all right? And I also mentioned that the way this graph is set up in the Davidson book, he says, well, and what's going to happen now is, and why he says this I don't know, because I know he doesn't believe it, that eventually, and notice how close together P sub S and P sub F are here, eventually they end up P sub S equals P sub F, all right? Net investment drops to zero, and all investment is just replacement, which means that entrepreneurs have reached the number of restaurants that they believe will be profitable, and all they're doing now is just replacing the stuff that wears out, all right? So we come to this steady state. The economy reaches a point, like let's say we had an economic expansion. Where am I going to draw my economic expansion? All right, economic expansion, and it just levels off, all right? It just levels off after that. Guess what? We all know that's not what really happens. We all know that this is what happens, all right? So that's the next thing that we need to add, all right?